Hello and welcome to this Saturday, June 22nd, 2024 edition of the EV Weekly Market Recap. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's absolutely a pleasure to be with you. Probably take the next 35 minutes or so and go through a recap of last week's action. If you weren't paying attention last week, you probably should be. There was some really important information coming through on the charts. As you know, here at Earnings Beats, we like to look at what's taking place on the charts, the story that's taking place on the charts, not so much what is taking place on CNBC or what all the talking heads are talking about. We like to know what's going on with the money. In fact, I was kind of joking a little bit, but I think if Earnings Beats had an anthem, it would probably be Money Talks by AC/DC. I think that came out probably in the late 80s, early 90s. It was one of my favorite bands. But you probably remember the lyrics. It went something like, come on, listen to the money talk. Got it? Anyway, that's what you got to do when you're looking at the market. And I promise I'm not going to sing anymore. But you've got to look at the market and understand what the charts are telling you. And so as I go through this, please kind of follow me, because I think there are going to be some major changes that could be taking place here in the near term, perhaps even over the intermediate term. So first, let me go ahead and start off with what happened last week. So we are going to look first at the Dow Jones. I'll go through the major indices with you. But the Dow Jones Industrial Average yesterday, or excuse me, on this past week, I'm going to give you a weekly chart here. So last week we went up 1.45% on the Dow. Saw a little bit of a change, more rotation toward the Dow later in the week and away from the S&P 500, and especially away from the NASDAQ 100. We're going to talk about that a lot today. But nice action, bouncing off the 20-week moving average and continuing to push higher here, as you can see, off of that 20-day moving average. Moving on, let's take a look at the S&P 500. So the S&P 500, this was the 8th time in the last 9 weeks that we have seen the S&P 500 put in a new high. It's another all-time high on a weekly basis, the weekly close. But if you're just looking on the surface, then you're not seeing the whole picture, because we always like to take a look at what's going on under the surface of the market. And again, we're going to talk about that quite a bit in today's session. But on the surface, S&P 500, 8th weekly high in the last 9 weeks, another all-time high. Things looking pretty good. Move on to the NASDAQ 100. This is obviously much more dependent on the technology area, and we saw a big reversal in technology late in the week, especially semiconductors. And again, that'll be a subject of a lot of discussion today. But in the meantime, we did actually finish up 0.2% last week on the NASDAQ 100, and like the S&P, finished up for the 8th time in the last 9 weeks. So again, on the surface, things look great. You know, should we just continue on as is? I say absolutely not. But again, we'll talk about that in just a minute. How about mid caps? Mid caps actually bounced off that 20-week moving average, very similar to the Dow Jones. Notice the mid caps are just here going sideways. There hasn't been any crazy move to the upside. No, we don't see any crazy overbought conditions. Same thing with the Dow. And if I pull up the IWM that tracks the small cap Russell 2000, same thing. I mean, you can see just sideways action. There's nothing going on here. There hasn't been any crazy buying. So bull markets are made of rotation. We want to see all groups participating, even if they don't lead. Not everything can lead the market to the upside. We want to see the aggressive areas lead, which we've been seeing for sure, but we want everything to participate. And we've got the Dow, we've got mid caps, we've got small caps, all sideways consolidating. So if we start to see some rotation, there are plenty of areas that I think still look very solid for investors maybe to reposition into. And that's going to be the theme of what we talk about here today. Finally, last thing I want to show here are the transports. Last week, having a nice week, gaining more than 2%. So while the overall market may have seen a big reversal Thursday and Friday, transports didn't really see any of that. Transports performed very well, closing near the highs for the entire week. So this is another area that long term, we had an uptrend. We've been kind of going sideways, maybe even squeezing in a triangle if you connect the highs and then also connect the rising lows. But overall, it's not a breakdown. It's not negative, certainly not a bearish looking chart. It's just on a relative basis, this group has been bearish. But that may all be changing as we head into the second half of the year. All right, moving on. Let's talk a little bit about retail, the retail group, the XRT. This is a widely diversified ETF that tracks a lot of retail stocks. Last week, the May retail sales came in below expectations. Market was I don't remember exactly what the number was, but our actual number came in below expectations. And you can see retail stocks didn't really do anything last week. I think overall we remain in an uptrend. We remain in sideways consolidation. So we got a little sideways consolidation pattern. But overall, I mean, I think the retail group just kind of is going sideways right now. How about the home builders? We've seen rates coming down, but we've seen a lot of negative housing reports out lately, which maybe the rates being up so long or so high for so long, maybe that's starting to have more of an impact now. But we saw existing home sales come in below expectations. Housing starts, building permits, both well below expectations last week. So I think we're starting to see more and more weakness in the housing group, and we're seeing it reflected in the chart. Now here you can see we had a nice kick save on Friday in the housing group. That was a pretty big support level right around 2,400. We were down to 2,383 intraday, and we came back up, had a kick save, and hung on to support, which was a good short-term development, at least on this chart. Will it begin to outperform again? I don't know. We'll see. But at least in the short term, we did have a nice recovery in the home building group. One of the reasons I'm a little nervous about the group is down here below. This is a relative strength panel showing the home builders relative to the S&P 500. So we topped back at the end of March here, and we've been going down April, May, and June, which if you follow this group historically is not really too surprising. You might find this a little surprising, but home builders tend to do best during the winter months from November through about February. That's when we tend to see the best performance on home building stocks. And I think it's anticipating the spring season. So I still think the economy is okay. I think we're teetering. I think we're seeing some cracks in the foundation. But overall, we remain positive. We've got another GDP report. It'll be the third reading, the final reading of Q2 GDP, or excuse me, Q1 GDP, and that'll be out later this week, I think on Thursday. But overall, I think the economy is still hanging in there. But again, starting to see some signs. Initial jobless claims will be out on Thursday. Watch for that one, because all of a sudden we're starting to see those jobless claims move up into a different area. We've been seeing jobless claims coming in around 200,000, maybe a little below or a little above. More recently, we've seen about 235, 245,000. So it's subtly been picking up a little bit. We've seen the unemployment rate creep up, even though it's still from a long-term perspective at a really low rate. But it has been creeping up a little bit. Just again, cracks in the foundation, nothing huge. But if the Fed doesn't act to cut rates, this is a problem that could begin to escalate as we get toward the end of the year or even into 2025. So I believe the Fed's going to cave and start lowering rates probably sooner rather than later. But one report to also watch this week coming up on Friday will be the PCE. This is one of the more widely watched inflation readings by the Fed. So when we get that report on Friday, see what it looks like. The annual rate, I think in January and February, was 2.5%. That jumped in March and April to 2.7%. So what's it going to be what's the May number going to look like this week? Well, I would suggest that we all watch for that on Friday, because the Fed's going to be watching it. The other thing, and I'm going to talk about semiconductors here in 1 minute, because this was a group that absolutely had a major reversal. And I think could be in have some serious problems ahead. But another sign that would tell you that that's the case, if we get a Friday report, a PCE report that suggests that inflation is coming down, normally growth stocks would go up on that news. If we see that on Friday and some of these growth stocks don't really get that positive reaction to the upside, especially an area like semiconductors, that's going to be another sign that this group is probably fully priced at this point. And it's kind of hard to argue that they're not. When you look at where the semiconductor index was, just back at the end of October, I think we were down around 900, and recently going up through 2100. I mean, we're talking about what, 7-8 months where we've jumped well over 100%, like 130%, 140% in 8 or 9 months. Now, hey, I understand AI is a big deal, but at some point you've kind of maybe built perfection into prices. And I think that's about where we are on the semiconductors, but I'll talk about them again here in just a second. Let me, there we go. Bring that screen back in line. So let's keep talking. All right. The various sectors last week. If we look at what happened last week, remember, I talked about June, consumer discretionary starting to show strength. That also carries into July seasonally. So consumer discretionary had a nice week last week. And even though some of these stocks can be subject to max pain during option expiration week, consumer discretionary had been weak for a long time. Many areas of consumer discretionary have not performed well at all in 2024. So the fact that we're just getting started to the upside, and you can see that a little bit in the scooter score over here on the right-hand side, that stock chart's technical rank. It's a relative strength indicator of sorts. The one limitation is that if you look at the formula, it only goes back about 5 months. So I think it's a really good indicator of relative strength, but only over the last 5 months. So if you're looking to compare, the relative strength of certain areas of the market since 2022, don't use the scooter. The scooter is focused on the last 5 months. But still, 57.4. Look at the next group, energy, 32.6. These were your two winners last week. And if we just looked at the last 2 days instead of the entire week, you would see all or many of the groups that had not been performing well really starting to do well on Thursday and Friday, whereas a lot of the groups that had been extremely hot went the opposite way. And that's why I always refer to options expiration week as opposite George week. For those of you that are Seinfeld fans, you probably remember the episode when George talks about how bad his life is and all his decisions have just been wrong, and he's just really down on himself. And Cherry and Elaine are talking to him, kind of laughing and saying, well, if every decision you make is wrong, why don't you just, when you come up with a decision, just go with the opposite, and then everything that was wrong will be right. And so George is like sitting there thinking about it for a minute. He's like, you're right, I should just do the opposite. And so the whole thing started because he saw a blonde-haired gal walk into their coffee shop or whatever, the diner, and sits down, and he made reference, that he saw her and thought she was nice looking, blah blah blah. And so Jerry and Elaine are like, okay, here's your chance, do the opposite. You don't think you have a chance, go up and talk to her. So he goes up and he talks about being bald, doesn't have a job, lives at home with his parents, and she turns around and says, wow, you're cute. Anyway, that's what it reminds me of, opposite George week in the stock market, where all of a sudden you look at areas of the market that have been horrible and you say, hey, you're kind of cute. And all of a sudden they come to life for a week or so, maybe longer. But that's kind of the thing you have to be thinking about as you go into option expiration week. It makes perfect sense because market makers have a ton. They have sold a ton of calls in groups that had been very, very strong, like semiconductors. We had record numbers of net in the money call premium on many of the semiconductor stocks and in that area in general. Technology, absolutely flying recently. Well, market makers have financial incentive because they're on the other side of those trades. So this is just a short-term inefficiency in the market, but market makers have the incentive to try to drive prices a little bit lower. Maybe not all the way to max pain. They'd probably do that if they could. But, I always talk about max pain and signals that we get that are directional signals, not that we're going to see a market crash, because that's basically what we would have needed in semiconductors to erase all of the net in the money call premium. That was very unlikely to happen. But every single bit of movement to the downside saves market makers literally millions, if not billions of dollars. And so you've got to be aware of it. We had our Max Pain event last Tuesday, and we were talking to members saying, and I used NVIDIA specifically as an example. And I said, what I use Max Pain for is that if I'm sitting back and I'm thinking, I want to buy NVIDIA, I've been a hot stock going up and I want to buy it. Knowing what I know about Max Pain, there is no chance, zero chance that I would have been buying NVIDIA on Thursday or Friday. If anything, shorting it would have been the better answer, because there was so much in the money call premium on NVIDIA. Billions of dollars of net in the money call premium on one stock. There were, I'm trying to think the amount of in the money call premium. I can't remember it off the top of my head. I can probably tell you though. Bear with me one second, because this is pretty important. There was on the Spider and on the QQQ. So the Spider is the ETF that tracks the S&P 500. The QQQ is the ETF that tracks the NASDAQ 100. Between the two of those ETFs, there were over $13 billion worth of net in the money call premium on just those two ETFs. Throw in several billion, many billion on NVIDIA, and you're probably over 20 billion in net in the money call premium just on those three stocks, or two ETFs in one stock. So the incentive for the market makers, it's there. If they can get control of the action and take prices lower, they're going to try to do it. Why wouldn't they? It's money on the table. As prices come down, they pay out less in premiums. So, and they don't get hurt. I always talk about this. They don't get necessarily hurt if prices keep going up, because I would imagine that what market makers do is when you go in and you want to buy, say, 10 contracts on NVIDIA, they're going to turn around and sell you those 10 contracts on NVIDIA. And if they're smart and they're hedging and they don't want to lose money, they would turn around and then buy 1,000 shares of NVIDIA, because every contract equates to 100 shares. So if you sell 10 contracts, you should turn around and buy 1,000 shares. And that's a covered call strategy if you're an option trader, if you understand options. And in that case, you've got the stock that protects you in case prices go up. You lose on the option, but you make money on the stock. And ultimately, you would end up making money on the premium. Market makers would, being on the other side of the trade. So they're not going to lose money. But think about this scenario. Retail traders keep buying NVIDIA calls all the way up. And then Thursday morning, we get this big gap up and money is pouring in to NVIDIA. I mean, now it's at 140 after the 10-for-1 split. So really it's 1,400. NVIDIA was a little over $100 in 2022. I mean, the movement in the stock's been absolutely phenomenal. But anyway, over the last month, we've seen another big run in NVIDIA. And so there were a lot of in-the-money calls. So what happens if market makers start to sell their long position in NVIDIA and then even go a step further and start shorting? They've taken profits on their long positions. They start shorting, price comes down, they make money on the short position, and the net in the money call premiums coming down. So they pay out less. Win on the long side, win on the short side, win on the options. Win. That's how market makers influence stocks around option expiration week, and why I talk about it every single month, because it's that important. Anyhow, getting back to the subject here, you can see a couple of groups, consumer discretionary and energy. These are two groups that really hadn't been doing well, and all of a sudden they led last week. And if you look at technology, it fell to 9th last week out of 11 sectors. And by the way, technology was up pretty good on Monday and Tuesday. So the only reason they're down there is because of the drubbing that technology took on Thursday and into Friday. A 24-hour period. I'm going to show you how much was lost in terms of just 24 hours. I'll show you some intraday charts in just a minute. First, before I get into that, I wanted to show you over the last month. So this is kind of going into June options. What areas had been leading the market to the upside? Renewable energy and semiconductors were the two obvious winners. Renewable energy, if you look at any of their stocks this past week, week and a half, First Solar down, Enphase Energy down, Solar Edge, which has been getting killed anyway, probably a lot of in-the-money puts there. Anyway, that stock was down. The whole entire renewable energy group really taking it on the chin here over the last week or two. Semiconductors, I'm going to go through a bunch of stocks with you in a minute, but these semiconductor stocks just got bludgeoned. Had the big gap up on Thursday, and then we sold off. The next 24 hours was incredible in terms of the market cap that got chopped off of these semiconductor stocks. NVIDIA literally went down 10% in 24 hours. I mean, if you weren't following it, if I hadn't been watching it, I wouldn't have believed it. But of course, I've been through Max Payne many times, so I know you've got to be careful when it comes to Max Payne. These groups that had been running that get a lot of option play, they're poised to have potentially a big drop, which is why it's too risky to buy. If you're going to buy NVIDIA, wait until we get past this period of option expiration and even the few days that lead into next week. The Monday that follows option expiration Friday, which is this Monday coming up, is the worst day of the calendar month since 1950. That's 75 years. That's a pretty bad day. The Monday after options expire goes up. It tends to go up about 37% of the days of those days. So down 63%. So obviously not a very, it's almost 2-to-1 chance that you're going to go lower. And the annualized returns since 1950 are minus 30% or more. I don't remember the number. It's been a while since I looked at it, but it is a bad, bad day. So with the way things finish this week, I wouldn't be surprised if Monday's another rough day. We'll see. But don't be surprised if the selling were to escalate in some of the areas, especially like the semiconductor area. Let's keep moving. So here's the semiconductors. I wanted to show you the 5-day. This is a 5-day chart. So here was the prior Friday, and then we had Monday, Tuesday, and then we were off on Wednesday because we had Juneteenth Day, and then Thursday and Friday were here. Look at the gap up on the semiconductor index on Thursday morning. We gapped up, and that was it, by the way. Look at the selling escalate, and then the gap down on Friday morning. From Thursday morning's high from over 21,000 to Friday morning's low, which was at 19.3. That's about 8% in the entire index gone in 24 hours. So next time I talk about Max Payne and the fact that we could have a big storm ahead, which is exactly what I wrote about last week. Here's the article. This was June 16th, last weekend. Prepared now for a potentially huge storm ahead. And if you read that article, you know I was talking about technology and some of the semiconductors. Right here, large cap technology names that have had such a strong run to the upside, especially in the semiconductor area, have also seen extremely heavy call buying. That means that we had Max Payne levels that were way below current price. And doesn't mean we're going to have a big drop. It just means that the risk is increasing. Nobody knows what the stock market's going to do. I can't tell you what the stock market's going to do, but I can tell you when the risks are elevated. That's what I was pointing out last week, and we saw it on Thursday and into Friday. Massive drop in the semiconductor area. So anyway, that's the 2 days, Thursday and Friday. And honestly, we might get a gap down on Monday morning. I would not be surprised. Moving on, let's take a look at the semiconductor index overall. Now, I'm going to annotate this chart because I think there are a couple things that you really need to pay attention to that happened this past week. There is, let me, hold on. So there is the Thursday bearish engulfing candle. And I want you to look down here below. Look at the volume. Now, if you listen to me, you know that there's only one primary indicator that I follow: price volume. That's it. The combination of price volume trumps everything else in the market. So when I get a massive reversing bearish engulfing candle after an extended uptrend, and it comes on this kind of volume, which is higher than at way higher than anything the rest of the year, I pay attention. I think that was an exhaustion gap to the upside, not just off of the last 6-7 weeks move to the upside in semiconductors, but again, looking at where we were back at the end of October last year, we were below 9,000, and we went up and opened right around the 21,000 level on Thursday. 12,000 points higher off of a 9,000 base. That is 133%. And it occurred in what, eight months? It's too much. And the problem is a lot of folks that weren't riding this are now seeing semiconductors going crazy, and they're jumping in with both feet. Unfortunately, timing was off. Now, if you look the last time we had the same thing basically happen, there's your bearish engulfing candle. And by the way, if we take a look at the volume, that volume right there on March the 8th, if you look back, was probably the second highest volume of the over the prior year. I mean, that was big volume. It's not as big as what we're seeing, what we saw this weekend or this past week, but it was the biggest. It was a massive volume reversal. Did we go up through that candle at any point over the next several weeks? No. We had some ups and downs, and I'm not saying that semiconductors are just going to go crashing lower. We may see some ups and downs, but until we take out 21,000 on semiconductors, I would absolutely be looking for this group to go lower. Now, some of you might say, well, oh my gosh, if semiconductors take a big hit, this market's in trouble. Well, if it leaves the market, it is, but if it rotates into other areas, it's not in any trouble at all. In fact, the way I'd be looking at it is I got a lot of opportunities in the other areas of the market now, because all that money that poured into semiconductors, as all this selling takes place over the next week or two, or maybe month or two, maybe longer, that money is going to find a home in other areas in the market. And I'm going to show you some of those areas in just a minute. We have a number of key sectors right on the verge of breakouts. So don't think you always have to be invested in semiconductors. I'm going to show you NVIDIA. Here's the 5-day chart of NVIDIA. Here it was jumping up from 135 and change to 140, or nearly 140, trading almost to 141. And then from 141 down to 124 and change in 24 hours. That's $17, which is like 12%. I think I may have said 10% earlier. 12% drop in NVIDIA in 24 hours. Massive selling. Massive selling. The volume was way heavier on the way back down. We got the gap up, saw a little bit of a reversal back up to hit this double bottom. That's where the support was on Thursday. We hit that resistance on Friday, and back down we went, closing not too far from the low of the day. I think we could be setting up for another drop on Monday in the semiconductors. Let's talk about seasonality, because this lines up beautifully with what I'm talking about on the semiconductors right now. If you look at the semiconductors, and I've pulled up semiconductors for the last 12 years. So let me make this chart just a little bit bigger here so everybody can see it better. So this slide bar down here at the bottom, this gives you the number of years. So you can drag it forward. You can drag it, look at the last 3 years. You can look at the last 20 years. That's the max. But I did 12 years because in 2013, that's when the S&P 500 broke out above its prior highs from 2000 and 2007. So that was the confirmation that a new secular bull market was born back April 10th, 2013. So what I'm looking at is what have semiconductors done during this secular bull market since 2013 relative to the S&P 500. And what we have here is it's broken down by calendar month. Now, if you go over and you look at the first month of each calendar quarter, which would be January, April, July, and October, let's really zero in on these numbers so you can kind of see them. There we go. If you add these up, this will tell us how semiconductors typically perform relative to the S&P 500, right? By month within a calendar quarter. Because what I'm going to do is I'm going to add up January, April, July, and October. So if I do that, I get 0.9 minus 2.7. So now I'm at minus 1.8 plus 0.7. Now I'm at minus 1.1 plus 0.1. So now I'm at minus 1. So the first month of every calendar quarter, semiconductors have averaged losing 1% to the S&P 500. In other words, semiconductors, which have been absolutely on fire since 2013, they don't get their strength in the first month of a calendar quarter. What month are we getting ready to go into? July. July is the first month of the third quarter. Doesn't really have very good numbers. I mean, look at April. It only outperforms the S&P 500 25% of the time. July is 55. October is 45. January is 58. These are the four lowest readings on the entire chart. Now let's add up the second and third months of calendar quarters. Second month of a quarter, February 3.1, May 5.5, that's 8.6. August 0.5, that's 9.1. And November 4.2, that's 13.3. 13.3% average outperformance each year just during these 4 months. February, May, August, November. Second month of calendar quarters. The third month, March 1.8, June 0.3, so that's 2.1. September 0.8, 2.9, December 0.5, that's 3.4. So 3.4 in the final quarter. Oh, what did I say? 13.3 in the second quarter, but in first quarters, we've actually dropped 1%. So we're going into a seasonal period that does not favor semiconductors, hasn't favored them throughout the bull market. And now we've got a massive reversal that just took place on the chart after a crazy uptrend, 133% in 8 months. Are you kidding me? Folks, take your money and run out of the semiconductor group. I'm going to show you here in a second some areas that you should be looking at. So broadline retail. Now, this is another aggressive group, but broadline retail right now, the high that we saw back in April on this chart, zero in here, was probably around 38.60, 38.70. I mean, on Tuesday of last week, we were probably trading almost at the exact same level. Certainly when we were hitting the 20-day moving average less than a week ago, we were trading at the same level we were more than 2 months ago, 2.5 months ago. This group hasn't traded like the semiconductors. It's an aggressive group and it tends to do well, but it hasn't really participated. But look, it just broke out on Friday. Now, I think you got to be a little careful because Amazon also has a lot of in-the-money call premiums, and Amazon's one of the big leaders in the broadline retail space. But Amazon, if you look at it on a relative basis to the S&P 500, I want you to look at the first months of the calendar quarter because this is what we're going into, right? January, 4.8. April, 2.5, that's 7.3. July, 4.1, that's 11.4. And October, minus 0.1, 11.3. So Amazon has averaged outperforming the S&P 500 by more than 11% per year during these 4 months over the last 12 years during the secular bull market. If you look at the other quarters, February, minus 0.4, May, 1.2, so now we're at 0.8. August, 1.6, that takes us to 2.4. November, 0.5, that takes us to 2.9. Outperformance in the second quarter, but not crazy outperformance. Not like the first quarter or the first month in each quarter. And then the third month in every quarter, March 1.6, June 2.2, that's 3.8. September minus 0.2, it's 3.6. Minus 2.6 in December takes us down to 1% outperformance. So once again, what you're seeing is a stock like Amazon that usually does very, very well during the month or during the first month of every calendar quarter. And if you look at July, it averages going up more than the S&P 500 by 4.1 percentage points over the last 12 years. And it's outperformed the S&P almost 2/3 of those Julys. So Amazon's got a track record of, looking pretty good in July. And I want you to look at the chart. We have a couple tops here at 190, and we can go back even further. Let's go back 5 years on Amazon. Let's go back 5 years and look at the tops from back in 2021, 188, 190, or 188, 189. That was in 2021. And now here we are, 189, 190. Look at the AD line already breaking out the new highs, telling me that there's accumulation. Why wouldn't I like Amazon going into, especially if I see a lot of money rotating out of the areas like semiconductors? There's a ton of money there. It's got to go somewhere else. Amazon looks like a likely target to me. It looks like Wall Street's already accumulating. So we're a little bit behind the 8 ball, but I see Amazon having a very strong month of July as it heads toward its next earnings report. Now, you want to take a look at some groups that I think look good. Here's, technology's been going crazy. I wrote about a negative divergence that it had last week. Of course, it's been going crazy in terms of its rate of change. These areas I'm about to go over don't have those problems. XLY, double top here, pulled back. We got sideways consolidation for the last 5 or 6 months. Since middle part of December, we've gone nowhere on the XLY. You think they're not in position maybe to take the baton and run with it here over the next couple months? I think they are. Watch for a breakout. XLY 185. That would be a big breakout. And of course, Amazon up that 190 level would be huge because Amazon is the biggest component of the XLY. How about energy? Energy's been going down for the last 2 months. Why might this go up? Well, take a look at what's going on with the crude oil prices. Crude oil prices just jumped to the highest level we've seen in 6 weeks. Energy, from where we were 6 weeks ago, the energy is way down. I wouldn't be surprised if we see a little catch up here. So look for energy. First sign would be a confirmed breakout over the 20-day moving average. We've really struggled with that over the course of the last several weeks. So if we can get through the 20-day moving average and sustain it, I think we have a chance to run up in energy. How about industrials? How about this double top right here? Support down here at about 121 or 120 and change. Let me pull that up. So you got a big uptrend followed by sideways consolidation. This is a continuation, a bullish continuation pattern. So 120 key support, beautiful hammer. Looked like we were breaking down. Instead, beautiful hammer. We're rallying off of it. Had another big hammer on Friday. Looked like we were rolling back over intraday, and then we came back up, closed near the high. I see this as an area where we could get a breakout over 126 and be off to the races again. So again, another area that might see money rotating in based on money rotating out of technology. Financials sideways consolidation. I think financials look good. Another possible area where we'll see a big reversal. Then you've got healthcare. Look at all these tops. 147, 148, probably 5 or 6 of them here over the last 3 or 4 months. What happens if we get a breakout above 148 in healthcare? And I could tell you, biotechs love the month of July. So some of the biotechs you might see show some leadership here as we go forward. But this is another group to watch. And then even consumer staples, like defensive areas. They've got, dividend payers that if money rotates a little bit more to value, you could see breakouts here. We've got a double top on the XLP just above 78. This is not a big mover. So if you take some of that money away from semiconductors, which is incredibly risky, and put it into something like staples, which is much more stable, I think that, I wouldn't argue with that strategy over the summer. Holding on to some nice dividend payers that are also in uptrends, by the way. This isn't in a downtrend. It's not like this group has been underperforming, or it's not like this group hasn't been performing well. It just hasn't been performing as well as the S&P or obviously semiconductors. But that's okay. As money rotates, you get new leadership. And so I think some of these areas I've just shown you could present some great opportunities, not just in the week ahead, but maybe over the next several weeks, maybe even a couple months. We'll see how all of this works out. But I see a lot of changes taking place from last week. I just wanted to make sure all of you are aware of it. I think it's really important to recognize the opportunities that are out there, along with the massive risk of holding on to semiconductors. Listen, nobody is more, I don't know if appreciative is the right word. I mean, I love semiconductors. I love that group. And I don't think this is the death of the semiconductors. I think it's just going to take some time for fundamentals to catch up with the price action that we've seen. And the market, I think, beat us over the head with that last Thursday, with that massive, massive volume reversal. Folks, that's like the combination of running out of buyers at the same time that sellers are getting more aggressive. And that is a recipe for lower prices. At the best, maybe sideways consolidation. But I actually think we're going to see a pretty decent pullback. I think from that 21,000 high on the Dow Jones US Semiconductor Index, don't be surprised if we pull back as much as maybe to 16,000. As a final chart, I'm going to pull that up and show you what I mean here. Here is the big move up. 16,000, 16,500 is where we broke out from the last reversing candle. We never went back and tested that area. We gapped up and went right on through. So we've got gap support, 16,500 to 17,000. We got the 50-day moving average right around 16,600. And if we pull up a weekly chart, guess where the 20-week moving average is? Right now, 16,000. So I wouldn't be at all surprised to see a fairly significant drop over the course of the next several weeks. Doesn't mean we might not go up at some point next week or the week after, but watch the high that was established with that reversing candle on the daily chart. I'll pull that up for you one more time, then we're going to wrap this up. Right here, 21,000, we gapped up. Look at the massive volume. Now, Friday's volume, I will say, is somewhat skewed because anytime we have quad witching, which is options expiration, monthly options expiration that falls in March, June, September, and December, you have quad witching, which always results in much, much higher volume. In fact, those 4 days are generally the 4 highest volume days on the S&P 500 every year. So don't be skewed too much by Friday's volume. I'm talking about Thursday's volume. And Thursday's volume was massive. Big reversal, opening at the high, closing at the low. Never a good sign. Be careful out there. Hey, if you like the video, please hit the like button. If you are not a subscriber currently, we're making some changes to our videos here on YouTube at Earnings Beats. And if you want to stay up and stay tuned and up to speed with all of our latest videos, make sure you subscribe to our channel. If you subscribe, turn your notifications on. That way, whenever we publish or produce a video here on this YouTube channel, you'll be alerted to it. You can come in and check it out. We are anticipating doing a lot more in the moment kind of videos that you're going to want to see almost immediately after we publish, kind of like this one. So make sure you do subscribe and check it out. We certainly would appreciate your support on YouTube. A big shout out to all of our members at Earnings Beats. I mean, you guys are the ones that really have helped us keep everything going. It actually helps us to do some of the free stuff that we do to reach out to a much larger audience. So we, again, really appreciate our paid members. Thank you so much. And I'll be back next weekend for another market recap. Be careful with those semis. Have a great day, everybody. Happy trading.